Welcome back to our series here on the short-term rental loophole, and now we are going to dive into bonus depreciation. This is where it really starts to click. It really starts to get real, get fun. You can start to see the tax savings working for you. So you should have a good idea at this point of what regular depreciation is. If you don't watch our last video in the series, you should have an idea of what qualifies as real estate activities, what you need to do to materially participate, and kind of how the normal short-term rental loophole works overall. And now we're going to dive into how can we get these losses and how can we accelerate and amplify them so that it really gives us some meaty tax savings. So what you need to understand is that the government, the US, they want businesses and they want people, they want US citizens and taxpayers to invest in things and to invest in big things. They want you to invest in real estate. They want you to invest in fixing it up. They want businesses to invest in vehicles, to invest in equipment. Like they want that. It improves the GDP. It does great things for the whole economy overall. So they really want that, and they make rules to incentivize that. Because of that, they've made rules for what's called bonus depreciation, which is essentially a way to take the straight line depreciation and bring a bunch of it into year one or into those early years. And right now you can bring all of it into year one because they just made bonus depreciation 100%. So it went back to 100%. That's where it was 2018 through 22. And then it had fallen down back to 100%, and it's now permanent. So it's never been permanent before. It's always been a temporary thing. It is now permanently in the code. It's 100%. This is a big deal. It's with the One Big Beautiful Bill Act that passed July 4th, 2025. Big deal. And this is going to change things for a lot of investors and make the short-term rental loophole that much more appetizing and that much greater for taxpayers. So in a prior example, we talked about a business buying a $10,000 tractor and writing that tractor off over 5 years. And you could do that. They could do that, but also you could write off all $10,000 in year one thanks to bonus depreciation. So what that says is, okay, the $10,000 still doesn't go straight on the P&L. It goes to your balance sheet, $10,000. But instead of taking it over 5 years, go ahead and take all $10,000 of depreciation in year one. So move all $10,000 over to the expense item. Now that's worth $0 on your books. Now you've got to know that that still works differently than an expense, because now if you go sell that tractor in year two, it's got a consequence. You're going to have to pay back capital gains, and you're going to have to pay back depreciation recapture because they let you take all the depreciation in year one, but you decided to sell it off. So it still works differently, but from an expense and a bottom line number, it looks the same as an expense. So you move the bonus over, but you do have to track it differently. So that's how something would work on that tractor. Same thing. Let's talk about you get your detailed invoice. In the last video, we talked about that. You had $10,000. You got the detailed invoice from the contractor, 5 windows installed were $5,000, and flooring installed was $5,000. Well, now those 5 windows, those expense immediately. No need to set them up as fixed assets or worry about you expense them. Those are $1,000 a window, $5,000 in repairs expense. The other $5,000 goes on your balance sheet. Flooring, $5,000. Take it all right away year one, $5,000. So now that full $10,000 bill is all over on your P&L as a deduction, an expense in year one, right? So it's starting to create some big tax savings, because before you were going to be able to take $5,000 and then an additional $1,000 a year over 5 years, right? So like now you can take all $10,000 in year one. Now, unfortunately, you cannot take bonus depreciation on a building. So you have that building that you purchased for $500,000, right? 100 went to land, 400 went to the building. They're not going to let you take that any faster. Straight line over the 39 years that you get that short-term rental building, right? You cannot take it as all in year one, right? So that's something you need to understand first and foremost, is you can't just take that all in year one unless you use something called a cost segregation study. And that's what we're going to dive into next. So if you're following along so far, hopefully you've got some good tips. You're starting to understand how you can use this better. But on that, where we start to talk about cost segregation study, the wheels should start to turn. You should start to understand where you can use this short-term rental loophole, how, and then we're going to dive through how to really use it and use it effectively if you want to do big things versus just kind of a one-off type thing. So let's get into cost segregations next. Be sure to catch that video.